Well, Squawk Box's Joe Kernan sat down for a rare and exclusive interview with Vice President Mike Pence earlier today. High on the agenda, the president's call for the Fed to help stimulate the economy.
There's no evidence of inflation in this economy.
So it's inflation.
We really do believe that, what the president was saying is the quantitative tightening has not been the right approach. That he's spoken out against the policies of the Fed over the last 2 years, like many presidents have before him.
Right.
But this is a president that really does believe that this economy is only starting to grow. I mean, you look at nations around the world, nations that we compete with every day, and the president really does believe that 3% is a starting point in this economy.
You can watch Joe's exclusive interview with the vice president tomorrow on Squawk Box starting at 6 a.m. Our next guest says she doesn't see the Fed cutting rates anytime soon. Let's bring in Rebecca Patterson, Chief Investment Officer at Bessemer Trust. Rebecca, welcome to you.
Thank you.
And I assume that's a good thing, a constructive environment for equities?
Well, with an unemployment rate at 3.8%, inflation, I don't necessarily agree with the vice president's comment that inflation's non-existent. It's not above the Fed's target of 2%, but it's just under 2%. We're seeing wages rising by almost 3.5%. So inflation's modest, but it isn't non-existent. So with that combination of factors, I can't see the Fed feeling any need to cut rates anytime soon. I think, if anything, the minutes from their meeting today showed that they're still looking at risks both ways. They've definitely paused. They're stopping the quantitative tightening sooner. But if we get a trade deal, if we get better global growth into the middle of this year, the Fed's saying, guys, just be careful. We could still raise rates if the environment were strong enough. If we saw oil prices and other factors lifting inflation to 2.3, 2.4, you can't rule out a tightening.
When you take a look at the performance of the various indices across the markets, does it concern you, for instance, that the S&P 500 is a couple percent from all-time highs, but we have the Russell basically in bear market territory? We got the NASDAQ up 20% this year. I mean, there's really seems to be a disparity here. How do you read those market tea leaves?
I've been struck this year taking the market and putting that on an economic lens by the disparity between services and manufacturing, international versus domestic. And so when you look at the breakdown between how the markets are performing, I think that's reflected there too. The U.S. economy is doing very well in terms of the consumer, right? We have rising wages, we have a low unemployment rate, we have high savings rates. The manufacturing side, globally, it's collapsed. The U.S. is getting pulled down by that. Part of that's Europe and China, part of that is the trade war. And so I think as we talk about earnings season, that's all going to come through in a lot of diversification in terms of the earnings guidance and numbers we get. And I think you see that reflected in the markets, too. If you have a company that's focused on the American consumer, generally speaking, they're going to be doing OK. If you have a company that's very tied to the international manufacturing cycle or trade, God help them right now. And so I think that persists until we get a trade resolution, if we get a trade resolution, which I'm not sure we do.
So let's talk about the other trade war that might be out there, the European trade war. How much does that worry? How much does that fit into your equity decisions?
So, the U.S.-China one, we will get a deal. I think everyone here would agree we're going to get some sort of deal in the coming months. There's a question around how it's enforced, what the details are, if it really makes people feel really good or not. Do they lift the tariffs or not? But then I think the next target for Washington is autos, and I think there's a lot of angst towards Germany right now in particular. They want Germany to import more LNG, natural gas, from the U.S. They don't want Germany to use Huawei or other Chinese tech for 5G. They want Germany to lower tariffs on autos. And Germany right now is pushing back fairly hard on some of this stuff. So the fact that we could threaten auto tariffs, I think, is very likely. Do we actually go ahead with tariffs? Not really a lot of support here in America for it, but that doesn't mean the rhetoric won't be there. And that rhetoric alone could be a reason that European equity sentiment stays capped, even if the valuations are relatively attractive.
So back to the Fed, the last I checked, analysts are pricing in a 60% probability of a rate cut by January of next year. What's your take on that?
So I think there is so much priced in here that the risk is skewed the other way. If we don't see a rise in inflation, the Fed's on hold. But why on earth would the Federal Reserve cut rates with the unemployment rate at 3.8%? So what makes me a little nervous, maybe not today, but over the course of this year, is that equities partly are getting the support on these Fed hopes. If they don't come to fruition and the market has to reprice that, is that a cap at least on multiples, perhaps, or certain types of sectors in the stock market. And I think it is. We still have a lot of equity exposure in our portfolios, but we're using pockets of strength to incrementally take some money off the table. We did a little bit of that in mid-February. And if I see another run-up on a trade deal, for example, with China, I'm going to keep saying thank you very much and just take a little bit off, because we think growth's going to slow pretty materially next year as fiscal becomes a drag for the United States. Maybe China's stable. I think Europe continues to face a lot of headwinds, even though the European Central Bank's fighting back.
It almost sounds like your portfolio is based on TINA. There is no alternative. I mean, because you're basically saying you would like to take some off the table. You see growth slowing down next year. But right now, this is the best place to be at this point.
Well, it's definitely not credit. The preferred point earlier aside, which I think is a good one, one thing the bank CEOs in their 7-hour marathon today, when they're asked what scares you, they all mentioned cyber. But in terms of market risk, the most common answer was leveraged loans, corporate credit. Last year, we saw record issuance of leveraged loans, over $700 billion just in 1 year globally. And you've got a less liquid trading market compared to the last economic cycle. You've got a lot of this stuff packaged in CLOs and sold to Asian retail investors. When the economy slows more, you're going to see a lot of people wanting to get out of this stuff ahead of a downgrade cycle. And a lot of it's issued by shadow banks that aren't as regulated. So there is a real reason, I think, for these bank CEOs to worry about that.
How big of a risk is that, in your view?
I don't think it causes a recession. I think it's going to exacerbate the equity sell-off when we get there. Because when people see their credit holdings losing money, they want to offset those losses by taking profits on stocks. So I think the two are increasingly correlated.
All right, so you're underweight banks. What are you overweight?
Our biggest overweight has been and continues to be tech, not a big surprise there. And that's served us well for the last few years. Obviously, we're being very mindful of which companies we're getting exposure to, but we're still very comfortable in that space. Doing a lot of work looking at the political issues around tech. What kind of regulation could we see? What's priced in? But for the moment, we're still pretty comfortable with that position.
All right, Rebecca, great to see you. Thank you.
Thanks for having me.
Patterson of Bessemer Trust. Guy Adami, what do you say?
You know, the Mike Pence thing is fascinating. I want to speak in hyperbole, but quantitative easing is an emergency measure that was put in place. If this is the greatest economy in the history of our republic, what's the emergency? Number one, right? I mean, to me, it's madness. And Mike Pence saying there's no inflation. I mean, I don't know where he's living, but gas prices have risen substantially over the last couple of weeks. Healthcare is ridiculous, and education costs are through the roof. We have inflation in all the wrong places. I don't really care what the Fed says inflation is. We live day to day. You know it's there. So it's a lot of crazy talk going out there. With that said, to BK's point, if the market thinks the Fed has their back, it's going to continue to grind higher.
Well, you know, she talks about credit, Rebecca, that is she, and we're talking about high yield. We're talking about the U.S. leveraged loan index. We're talking about measures of stress in funding, and it's just not there. In fact, I think right now you have kind of a sweet spot, which is that you actually have rates that are going lower with GDP that at least is flat to sideways. It does not mean that there isn't trouble ahead. Debt to GDP, we talk about this. It's absolutely something to watch. But if you're playing tactical markets right now, credit is not your enemy.